using Fibonacci sequence to make you rich in the stock market. Many people think that the stock market is a gambling game. You might as well go to Vegas and put all your money on black, they say. But what if I told you that there is a way to beat the odds and come out ahead? The Fibonacci sequence is a series of numbers in which each number is the sum of the two preceding numbers. And believe it or not, this centuries-old mathematical concept can be applied to investing in the stock market. In this YouTube video, we will explore how you can use the Fibonacci sequence and all its variations of it to make money in the stock market. How can the Fibonacci sequence be used in the stock market? The Fibonacci sequence is a series of numbers where each number is the sum of the two previous numbers. The sequence starts with 0 and 1, and the next number in the sequence is 1, 0, 1. Therefore, the Fibonacci sequence is 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89. The Fibonacci sequence can be used in the stock market by using it to identify support and resistance levels. A support level is a level where the price of a stock tends to find support when it falls. A resistance level is a level where the price of a stock tends to find resistance when it rises. The Fibonacci sequence can also be used to identify trend lines. A trend line is a line that connects two or more price points on a chart. By connecting these points, you can see if there is an overall upward or downward trend. Lastly, the Fibonacci sequence can be used to time your entries and exits in the market. By knowing when these key levels are reached, you can make better decisions on when to buy or sell your stocks. What is Fibonacci retracement? Fibonacci retracement is a technical analysis tool that traders use to identify potential support and resistance levels. The Fibonacci retracement is based on the Fibonacci sequence, which is a series of numbers where each number is the sum of the previous two numbers. The Fibonacci retracement can be used in conjunction with other technical indicators to help confirm trading signals. The Fibonacci retracement is created by drawing a line from the high point to the low point of a stock's price movement. Then, horizontal lines are drawn at the 23.6%, 38.2%, 50%, 61.8%, and 100% retracement levels. These percentages represent possible support or resistance levels for the stock price. When the stock price is trading below the 23.6% Fibonacci retracement level, it is considered to be in a bearish trend. If the stock price is trading above the 23.6% level, it is considered to be in a bullish trend. Traders will often look for other technical indicators to confirm a trend before making a trade. How to use Fibonacci retracement? Fibonacci retracement is a technical analysis tool that uses Fibonacci ratios to estimate the extent of a correction or pullback in a stock's price. The theory is that after an up move or a down move, the stock's price will retrace or pull back by a certain percentage of the move before continuing in the original direction. The most common Fibonacci ratios used in Fibonacci retracement are 23.6%, 38.2%, 50%, and 61.8%. To use Fibonacci retracement to indicate stock movement, first identify the recent high and low points in the stock's price history. Then, using a charting program or online charting tool, plot the Fibonacci ratios above and below the recent high and low points. The 23.6% line will be closest to the recent low point, while the 61.8% line will be closest to the recent high point. If the stock's price starts to bounce off of one of these lines, known as support or resistance, it may be an indication that the stock is about to resume its original trend. However, it's important to remember that Fibonacci retracement is only one tool that can be used to analyze stock movement. Other factors, such as volume and momentum, should also be considered before making any investment decisions. Pros and cons of Fibonacci retracement. When it comes to technical analysis, there are a few tools that are more popular than a Fibonacci retracement. This tool is used by many traders to help identify potential support and resistance levels in the market. In this article, we will take a look at the pros and cons of using Fibonacci retracement in your trading. The pros. One of the biggest advantages of using Fibonacci retracement is that it can be applied to any time frame. Whether you are looking at a long-term chart or a short-term chart, Fibonacci retracement can be useful in identifying potential support and resistance levels. Another advantage of Fibonacci retracement is that it is relatively easy to use. Once you have identified the most recent swing high and swing low on a chart, you can simply plot the Fibonacci levels and look for potential trading opportunities. The cons. One downside of Fibonacci retracement is that it is not always 100% accurate. While it can be a helpful tool in identifying potential support and resistance levels, there is no guarantee that the price will reverse at these levels. How to use Fibonacci extension to find trends in the market. A Fibonacci extension is a tool that can be used to identify trends in the market. The Fibonacci extension is used by drawing a line from the high point of an uptrend to the low point of the same uptrend. Then, you draw another line from the low point of the uptrend to the high point of the next uptrend. By doing this, you can see where the market is likely to head next. You can use Fibonacci extension to find trends in any time frame, whether you're looking at a 1-minute chart or a monthly chart. In this blog post, we'll show you how to use Fibonacci extension to find trends in the market. What is Fibonacci extension? The Fibonacci extension is a tool that can be used to identify potential areas of support and resistance in the market. This tool is based on the Fibonacci sequence, which is a series of numbers that starts with 0 and 1, and then each subsequent number is the sum of the previous two. The Fibonacci extension is used by drawing a line from the high point of an uptrend or the low point of a downtrend, and then extending this line out to the right by one of the Fibonacci ratios, 0.382, 0.618, 1.000, or 1.618. This extended line can then be used as a potential area of support or resistance for the market. How to use Fibonacci extension. Fibonacci extension is a technical analysis tool that can be used to identify potential trend reversals and continuation patterns in the market. Here's how to use Fibonacci extension to find trends in the market. 1. Identify the recent high and low price points on your chart. 2. Measure the distance between the high and low points and apply this measurement to the Fibonacci extension levels of 23.6%, 38.2%, 50%, 61.8%, and 100%. 3. Look for potential reversal or continuation patterns at these Fibonacci extension levels. 4. Enter or exit trades based on your analysis of the market trend. What are the benefits of using Fibonacci extension? When it comes to technical analysis, one of the most popular tools is Fibonacci extension. This tool is used to identify potential support and resistance levels in the market. One of the benefits of using Fibonacci extension is that it can help you find trends in the market. By identifying key levels of support and resistance, you can better predict where the market is heading. Additionally, Fibonacci extension can also be used to set profit targets. By knowing where potential support and resistance levels are, you can better set your price target for taking profits. Overall, Fibonacci extension is a helpful tool for any trader who wants to get a better understanding of the market. By identifying key levels of support and resistance, you can better predict market movements and set realistic profit targets. How to find trends in the market using Fibonacci extension. When it comes to Fibonacci extension, there are a few key things that you need to keep in mind. First and foremost, you need to identify the most recent swing high and swing low in the market. From there, you can then calculate the Fibonacci extension levels. Once you have your Fibonacci extension levels, you can then start to look for potential trend reversals at these levels. A lot of times, you will see the market reverse at these key Fibonacci extension levels. So, if you are looking for trends in the market, paying attention to these levels can be very helpful. What is Fibonacci time zone? Fibonacci time zone is a tool used by technical analysts to predict future stock market movements. The theory behind Fibonacci time zone is that the stock market moves in cycles, and that these cycles can be identified and measured using the Fibonacci sequence. There are a number of different ways to use Fibonacci time zones to predict the stock market. One common approach is to look for price levels where the market has reversed direction in the past. These price levels are known as Fibonacci retracements, and they can be used to predict support and resistance levels in the future. Another way to use Fibonacci time zones is to look for patterns in the timing of stock market moves. For example, many technical analysts believe that the stock market tends to make significant moves every 21 days, 3 weeks. This belief is based on the fact that 21 is a Fibonacci number. Similarly, many technical analysts believe that the stock market tends to make significant moves every 34 days, 5 weeks. Again, this. How to use Fibonacci time zone to predict the stock market. Fibonacci time zone is a technical analysis tool that can be used to predict stock market behavior. The Fibonacci time zone is based on the Fibonacci sequence, which is a series of numbers where each number is the sum of the previous two. The Fibonacci time zone is divided into sections based on the Fibonacci sequence, and each section represents a different length of time. The Fibonacci time zone can be used to predict stock market behavior by identifying key turning points in the market. These turning points can be used to enter or exit positions in the market. The Fibonacci time zone can also be used to identify support and resistance levels in the market. Pros and cons of using Fibonacci time zone. There are many different ways to use Fibonacci time zones to predict the stock market, each with its own pros and cons. Some methods are more accurate than others, and some are more suited for certain types of markets. Some of the advantages of using Fibonacci time zones include that they can be used in any time frame, they can be used to identify both short-term and long-term turning points, and they can be used to generate trade signals. Some of the disadvantages include that they require a bit of experience and knowledge to use effectively, and that they are not always 100% accurate. One method of using Fibonacci time zones is to plot them on a chart of the market you are analyzing. This will help you to see where potential support and resistance levels may be. Another way to use them is to look for crossovers between different Fibonacci levels, which can indicate a change in trend. No matter which method you choose, it is important to remember that Fibonacci time zones are just one tool in your arsenal and should not be relied upon exclusively. Use them in conjunction with other technical indicators, as well as fundamental analysis, to get the most complete picture possible before making any trading decisions. Conclusion. There are a lot of different strategies that people use to try and make money in the stock market, and the Fibonacci sequence is one of them. While there's no guarantee that using this method will make you rich, it is definitely worth considering if you're looking for a new way to approach the market. Who knows? Maybe the Fibonacci sequence could be your key to financial success.